the recording on. Share this with others. All right. I'm here today with Franklin Spees of IWF. Franklin is an investment and due diligence partner on multiple projects with SMK. And before we start, I just want to mention that Bridgepoint Apartments is the first standalone property that we've offered to investors in over 8 months. And we're going to share with you why this investment really stands out from really the hundreds of other opportunities that we've said no to. So give me just a second here. I will share my screen and we can jump in. Okay. All right, can you guys see this all okay?
Yes.
Perfect. All right.
Okay.
Throughout the presentation, guys, you can ask questions. You can use the chat button at the bottom of your screen. We'll leave time to the end to go through everything. For this opportunity, we're projecting investors to earn anywhere from 16 to 19% average annual ROI and a 1.7 to 2.0 equity multiple.
All right. Hello, everybody. I'm Franklin, as Mark said. Good to see everyone. Before we start, here's some standard disclaimer language that we'd like to go through. All investments involve risk, right? We're just asking everyone consult their legal and financial and tax professionals. This overview is not an offer to sell. For those interested in investing, additional disclosures and the formal offering docs are available through the owner portal. Okay, now let's get into the overview. This will be a brief 25-minute overview covering, we'll just go right through it. Why now? Why the apartments, actually the apartment market update. And then we'll go into why this property, why the Bridgepoint Apartments. And Mark and I have identified 5 different areas that we wanted to talk about that we consider to be competitive advantages for this property, for this opportunity. The first one is price, related to the fact that it's a forced seller. So we got a discounted price. The second is the loan assumption. We are securing or assuming 3.57% fixed rate in this market. Also, there's positive leverage of 2.76%, which we'll go into. And then uniquely, there is a 50% annual property tax exemption that is secured in perpetuity on this property. And finally, we'll end by profiling the extent of our value add business plan. Then we'll go into the pro forma projections, followed by the property location of where it is located in Texas. And then we'll profile our operating partner. And we will end with some projected investor returns, as well as a live Q&A. Back to you, Mark.
Thanks, Franklin. Let's quickly dive in, guys, on the apartment market in the U.S. As many of us know, U.S. apartment pricing peaked around the middle of 2022. This chart is a pretty good example showing some of the trends. This is the Commercial Property Price Index for the past 7 years from Green Street Advisors. Now, what you'll see here is that apartments are in green, and they peaked around 2022, right around the middle of 2022. That is when inflation peaked at a little over 9%. That is when the Fed started raising interest rates at the fastest pace in over 40 years. The result since then has been pricing down anywhere from 10 to 30%. And you can see that in green here. So we've seen price drops over the past 2 years. And what I really want to point out is that we are not trying to time the market. That is a fool's game. But we do feel that it's important to know pricing trends. And thus far, apartment pricing has remained essentially unchanged since November, with a slight increase in apartment values over the last couple months, which you can see here just starting to tick back up. So it's just a signal, perhaps we've reached a bottom. Now, nobody knows, of course, but we are seeing growing optimism for the commercial real estate sector. Blackstone, the world's largest commercial property owner, pretty much paused a lot of their investments for most of 2023. And now, just 6 months ago in January, they start calling a bottom. And I'll read some of the quotes. We're heading to a better environment with the inflation and cost of capital moderating. This is from the COO of Blackstone, Jonathan Gray. They also mentioned we'll look back at 2023 as a cyclical bottom for our firm. And this is quite telling what it mentioned here. It's during this period of time where there's still uncertainty and you're bouncing along the bottom where we want to be aggressive. So what do they do next? Blackstone buys a $10 billion public REIT. This is all apartments. This investment included 27,000 apartments across 10 states. This was just in April. They're planning to put another $400 million into this portfolio to boost growth. And so we just look at this as a market leader feeling very confident in the future outlook for apartments. Couple data trends I want to share with you. Before we get into charts, the US continues to face an affordable housing shortage. There's lots of data on this. Essentially, there's just not enough affordable housing to meet the demand in this country any longer. And this has been a long-term trend. We've been tracking it for over 5 years. And today, if you look at this chart, home ownership remains out of reach for the majority of Americans. This is the cost of renting versus a monthly mortgage payment. And the gap here is the largest it's been on record. So just simply put, more and more Americans are being forced to rent. A couple more stats we want to share with you. If you look at annual rent growth for apartments, what you'll see here on this chart, this is rent growth on average, typically 2, 3, 4% a year. In 2021, skyrocketed up to 15. Some markets were over 20%. This is average for the US. And then what you see is right around the same time, early mid-June, rent growth started dropping. This was again at the peak of inflation when the Fed started raising interest rates at a very record pace. If you look at the bottom, the last couple quarters or so show the continued growing demand for apartments. So again, not trying to time the market here. We're just showing some important data points that perhaps the worst is behind us.
Great. Now, in light of those existing market conditions Mark just mentioned for apartments, we are now pleased to provide investors with access to the Bridgepoint apartments. And this ultimately, we've determined, provides a stable stream of passive income with a heavy focus on capital preservation and growth. Now, this is a Class B workforce housing apartment community. Mark and I actually flew out about a month ago and toured the property with the lead operator and also the property management company. And we observed the conditions of the property. It was overall in pretty good condition. And what I mean specifically is it was very clean. It was quiet. We were even told that a lot of the residents don't even lock their doors at night. This is a 1986 vintage. It's on about 10 acres, again, 200 units, got ample parking, and 152 of the units have washers and dryers in them. There's also on-site facilities at the property, and it was 93% occupied when we were there. We'll get into more of this, but there were amenities of private balconies, a swimming pool, picnic areas, a dog park, fitness center, and a sport court. This property is located about 30 minutes south of downtown Dallas in Waxahachie, which is a rapidly growing submarket, which we'll get into as well. We're currently in escrow right now to purchase this 200-unit apartment community at an attractive price, lower than any of the comps that we were able to find. And for additional reasons, we'll detail that shortly as it relates to the price. The business plan is to allocate $4 million towards a comprehensive value-add plan. Our operating partner, who we've partnered with before, will be leveraging their in-house construction management team to renovate all 200 units at the property. This is what's going to enable us to achieve the average rental premiums of about 20% across the board. achieving our goal to grow the NOI from about 1.4 million day one up to 2.4 million by year 5, which is the length of the hold period. Now let's talk just a little bit more specifically about the purchase price. This is what really one of the competitive advantages that led us to select this property, specifically with this operator. This first competitive advantage is the fact that it's a forced sale, as I mentioned. It's in 2023, this seller received an offer. So this is just last year. Seller received an offer from a known buyer at $31 million. They rejected it and they countered at 34. Well, that transaction failed. And now, due to the seller having a 5-year mandated term, they must sell. Our operating partners are under contract to purchase the property for $25.9 million. So it's roughly $5 million less, or about a 16% discount from that previous offer. Mark, I'll send it back to you.
Thanks, Franklin. Yeah, the next, I would say, very attractive competitive advantage of this deal is the loan assumption. So the loan originated in 2019. That's when the seller purchased the property. It's a 10-year fixed rate loan, and we are assuming that seller's loan. We're taking it over. It's fixed until 2029, so there's 5 years left, and it's fixed at 3.57%. Now, we can't find another loan like that today. It's not possible, doesn't exist. If this investment was shopped for financing in today's market with the interest rates today, it would be more like 5.5 to 6%. And all other things being equal, excuse me, that would increase the annual debt payment by over $250,000 a year from what we're paying. Now, one of the reasons our operating partners were able to secure this deal, first of all, they've bought other properties from the same seller before. So they have a positive transaction record with them. Secondarily, they are a select sponsor with Freddie Mac. Now, Freddie Mac is the lender on this deal. And being a select sponsor is essentially, it's a coveted designation by Freddie Mac that recognizes some of the top borrowers in the US that have successful track records, that also are aligned with Freddie Mac's mission, which is to provide liquidity, stability, and affordability to the US housing market. So that really allowed the seller to feel comfortable that our operating partners were the group to go with that would successfully assume the loan and close on the sale. Here we've got some highlighted debt terms. I just want to share with you a few points. The loan to purchase price, 66%, with a loan to cost of 55.6%. So conservative, low leverage, of course, fixed interest rate of 3.57%. And then we look at the DSCR, the debt service coverage ratio of about 1.95x. Really just means that there's enough free cash flow after paying the expenses and the debt to almost pay the debt twice. And so a lot of margin, a lot of padding, very strong way to start out an investment in year one. Okay, the next competitive advantage, positive leverage. This is something we look for in everything that we're investing in. And I'll share with you kind of an overview of how we analyze this. But when we take into account the tax exemption, which we'll get to in a moment, the going in cap rate is 6.33%. With a borrowing rate of 3.57%, we have 2.76% of positive leverage. Why does this matter? Well, essentially what it does is it greatly increases the return on investment for us as investors, but also it greatly reduces the risk because the debt costs less to service than the cash flow being produced by the property. All right, next competitive advantage. We are putting in place a 50% property tax exemption. Now, to qualify for this tax exemption, the way it works, half of the units at the property will remain income and rent restricted, and they will be rented to folks that earn 60% of the area median income, the AMI. It's a formula, and basically we're providing affordable housing. The other half of the units will remain at the market rate and unrestricted. A very important part here, we do not need to lower the rents on the affordable units at the property. And we've done several property tax exempt deals over the last few years Most of them require us to reduce the rents to meet that formula and tax exempt requirement. And in turn for doing that, you're given a pretty healthy tax savings. Another advantage here is we do not need to lower the rents. So what does this do? It provides us with an annual savings of around $278,000 starting in year one. Now let's put a value on that, right? We like to look and see with these types of assets, they are valued based on the amount of income that they produce, just like a business. So if we're increasing the income by the $278,000 savings in taxes, if we apply a 5.75% cap rate, we estimate the value growth at a little over 4.8 million at the onset and acquisition of the property. When we apply that to the actual equity or investor capital, it's a 35% increase in equity at acquisition. So what we're showing you here, guys, is there's significant value being created at the time of purchase because of the property tax exemption alone. Franklin, over to you now.
Okay, so we've thrown a lot at you so far. So far, we've talked about the advantages of price reduction, of loan assumption, positive leverage, and then a property tax exemption. So finally, we want to review our value add plan, our renovation. And let me just go right into that. You can see from the slide, interior, we're planning on painting and also full exterior and unit interiors. Okay, so then interiors in the units, we're resurfacing the countertops. Again, we walk these countertops and in the kitchen and all the bathrooms. The appliances in 60% of the units, we've decided to put in stainless steel for the flooring throughout as needed with vinyl. The cabinets are going to be keeping the boxes. We're painting in the kitchen and bathrooms and adding new cabinet pulls. For the lighting, it's going to be replaced throughout, new lighting package. Ceiling fans, one of the things we noted when we were walking with the property manager is that it's the most requested item from residents is to have ceiling fans installed in the units. And so we've put that in our capital budget to put ceiling fans in the kitchen and bathrooms throughout the property. One of the other things we did observe is that
in the bedrooms. I don't know that we want ceiling fans.
Oh, did I say kitchens? I mean,
okay.
Kitchens and bathrooms.
Yeah.
Sorry, in the living rooms and bedrooms. Thank you, Mark. That's why we're teaming up on this deal.
There you go.
The other thing we observed in touring the property is that on the 10 acres of all the buildings, all of the roofs had just been redone. So in January 2024, they just put on a new roof throughout the property. So it's a huge upside for us. And then the further exterior improvements, we've got about $300,000 allocated towards clubhouse, upgrades to the clubhouse, the fitness center, the pool, the outdoor amenities, and others.
Okay, let's look at some of the comparable rents in the immediate area. We'll start with the one bedrooms. What you'll see is this comp set has an average rent of $1,333, where our in-place rents are $1,076, so roughly 24% discount to the comp set. Now we're estimating once we renovate these one bedrooms, we'll be at $1,295 a month on average, so well within the current comps today. If you look at the two bedrooms, very similar analysis. The comps are about $1,537 a month. We're at $1,323 today. Post renovation, getting them up to right where the comps are today. So very excited about the renovation plan and bringing the rents up to market. Okay, this is our income statement. I'm only going to spend about a minute or two on it. Obviously, this is pretty dense, and so I just want to highlight a few points. If we look at the property taxes here in gray, this is the seller's historical 12-month financials going through March. They're paying $528,000 in taxes. Of course, with our property tax exemption, that drops to $239,000 first year. Big savings there. Total expenses were $1.6 million, and you can see ours are reduced to $1.3 million, again, largely due to the property tax exemption. So what you end up with is net operating income. Actually, this is for March, but in April, it was a little over $1.4 million for the seller. And we're estimating about 1.79. So immediate increase to net operating income, again, as a result of the property tax savings. And if you look down at the bottom here below the line, This is the monthly mortgage payments. So each year we're paying down principal and interest. So it's amortizing. And so what you can see is that the principal reduction here is a little bit under $2 million with each monthly payment and for the duration of the 5 years. So what we end up with is net cash flow at the bottom, very strong, healthy net cash flows. Again, almost the same amount as the debt service, which really gets us to the 1.95x debt service coverage ratio. A quick point, we did some sensitivity analysis. If you look at the current debt terms, the property can absorb 38% vacancy and still meet the expense and debt obligation. And the property is 93% occupied. So there's a lot of room and padding on this if something should go wrong to still be able to pay all the expenses and debt. Market overview, Franklin.
All right, thanks. So leading the financials of the property, let's shift over and talk about the market and the location. So the Bridgepoint apartments are located, as I said, just 30 minutes south of the DFW area and still within the southern metro area. DFW is home to 24 Fortune 500 companies, and it's the fourth largest metro area in the US. As you can see there on the slide, it's the #1 in the country for 3-year job growth. The metro's workforce is expected to reach 4.5 million by the end of 2024, which would make it the fourth largest employment base in the country. Move forward here. This map gives you a sense, as I mentioned, it's just to the south of both Dallas and Fort Worth. Next slide there. Other examples of economic vitality and being in what they call the path of progress is the existing presence of so many national and other large retailers who each individually, do their own market studies of household income, traffic counts, and market demand when choosing where to locate. You can see the location of our apartments down there at the bottom, outlined in blue, with all of these major retailers located along the 287 freeway, all within a 5-mile radius of this property. Let's talk a little bit about population. Waxahachie's average household income is over $94,000. So the people that are coming, as we're talking about population, that's the average household income in Waxahachie, which is also positive. The population has doubled, as you can see in the chart, in the past decade, and it's also projecting another 10,000 people to move there in just the next 5 years. This next slide shows an interesting visualization of census data, looking at the moving trends over the past 3 years, particularly with young people. And I'm talking about ages 20 to 34. You notice the reduction in population in California cities like LA, San Francisco, and Oakland. They're losing population. Well, Texas is certainly represented with, as you can see, San Antonio, Austin, and Houston in the upper right quadrant. But look over to the far right, the highlighted in yellow, that's where Dallas-Fort Worth is. They have had an influx of 125,000 young people moving into the region.
Thanks, Franklin. Quick overview on our operating partners. This will be our 7th investment with them. They were established in 2007. They're an industry leader in affordable housing. To date, they've acquired approximately $4 billion of properties with more than 36,000 apartments across 15 states. You can see that their management headquarters is in Beverly Hills, California, whereas property management and construction management are all in the Dallas area. This is a quick overview outlining their current apartment portfolio, almost 19,000 units in Texas. Our operating partners are a vertically integrated firm. They do almost everything in-house, acquisitions, asset management, you name it. They also have, as I mentioned, property management and construction management with over 700 professionals across the country. This is their track record. They've gone through 32 full cycle investments. The average ROI to investors is over 2x, doubling investors' capital. Average investor IRR is almost 33%. And on 18 separate occasions, they've returned all of investors' capital, but while remaining in the deal, predominantly through refinancing.
All right. In summary, as we close, this slide captures the primary takeaway or the theme that Mark and I have sort of determined for this particular overview and this investment that distinguishes this opportunity from the dozens and dozens of other deals that we reviewed over the last 7 to 8 months. So let's just walk through them real quick. Again, the 5 are, there's a forced sale. We've got a $5 million discount or a 16% off. We've got an interest rate at 3.57 fixed with Freddie at 55.6 LTC. That's loan to cost. We've got positive leverage, as Mark discussed, at 2.76%. We've got a 50% annual property tax exemption that will take place year one and last in perpetuity. And finally, our business plan we talked about of the entire 200-unit renovation. So these are the 5 primary points that create this overall low-risk profile of this deal. Mark and I are always scouring for the market for inefficiencies and opportunities with competitive advantages just like this. I would say good investments have maybe 2 of these. We have yet to find a deal that has all 5, which is why we're pretty stoked on this deal.
All right, thanks, Franklin. Let's shift over, guys. We're going to wrap up in just a minute here. I just want to share with you the projected returns. We have 3 class shares with different minimum investment amounts ranging from $50,000 for Class C, $250,000 for Class B, and $500,000 for Class A. The preferred return is 7 to 8%. That accrues annually. And so once we reach that hurdle, investors are earning 7 to 8% each year. That's when SMK, the management, participates in the profits and cash flow. And that participation is 70 to 80% to investors and 20 to 30% to SMK. Projected investor IRR is 14 to 16%. Projected investor average annual ROI is 16 to 19%. And again, the investor equity multiple 1.7 to 1.9x. Our projected cash flows to investors, year 1 and 2, 3 to 6%. Year 3 to 5, 5 to 8%. We have an annual management fee of 1% and a one-time acquisition disposition fee at the time of purchase and sale of 1%. It's a 5-year hold, and we do investor distributions quarterly. Lastly, we are estimating year 1 passive losses between 50 to 60% of invested capital. Timeline, we are closing at the end of June. So we're asking all investors that haven't already done so to execute the subscription documents by Friday the 14th. We have a funding deadline of the following Friday, the 21st. And now we mentioned here there might be 2 to 3 weeks available past that funding deadline. The reason for that is we have, as mentioned, $4 million set aside for CapEx, renovations. Not all of that capital needs to be in at the time of close. So our operating partners have given us a bit of flexibility. If some folks need to fund past the 21st, we should be able to accommodate that. Just let us know ahead of time. Next steps would be to log in to our website here, smkcap.com, review the details, the offering documents, and reach out with any questions. Okay, this is Franklin and I's contact information, and then we can open it up to any Q&As that you guys will have.
All right, and I sent a reminder in the chat that anybody can add any questions that you have. We can go back and review things. I've got a few questions here, but just wanted to open it up if anybody had any specific questions they wanted to mention, or we'll jump right into them. Mark, why don't we start with this one? This one says, part of the risk reduction, as it relates to risk reduction, how specifically, basically around the lease audit. You mentioned a lease audit and a market survey. Maybe you could speak a little bit more to that.
Sure, yeah. As part of the due diligence, what we did in conjunction with our operating partners was a full lease audit, reviewing all of the existing residence leases, to get a sense of their qualification and how many of them work, how many of them don't work, that kind of thing. What we found, some pretty attractive things that we can share with you. First, the median resident age at the property is 35, which is great. The average tenant tenure is 23 months. The average monthly resident household income, so how much folks make that live there now, almost $52,000 a year, which gives them a 3.5x income to rent ratio. Now, the requirements to rent at the property are 2.5x. And so the property is very well afforded by the residents. Another thing we looked at, Franklin, as you remember, the immediate neighborhood, right behind the property, homes are selling anywhere for $350,000 to $500,000, and they rent for over $2,000 a month. So we're very much providing an affordable product at the property. I don't know if that helps answer the questions on the lease audit. Was there another question that they had asked there, Franklin?
I think that covers it. And I want to encourage anybody that would like to come off mute. You can also ask it verbally as well. But let me just go back to the chat here.
Oh, not allowed to unmute.
Okay, maybe you can
see here.
I've
Not
got
sure
a
how to do
question.
that. Yeah, I would say let's just type in all the questions to keep it simple.
Sure. I've got a question here on insurance, which I'm happy to field here. As we know, as we probably have all experienced, whether it be on our single family or our businesses or larger commercial properties, insurance has definitely spiked over the last maybe 12 to 15 months specifically. And I would say, looking at a property, the largest expenses on a property are typically your property taxes, your insurance, and your debt. And we talked about two of those things. And here with insurance, one of the things we learned from our operating partner, again, that has, I think it's close to $2 billion in assets under management and managing, over 20,000 units just in Texas alone. One of the things we learned is that the owner of the company actually flew to London to meet with Lloyd's of London and was able to structure what's called a captive. It's like a master insurance policy, which is essentially leveraging their existing large, robust portfolio in order to secure, somewhere in the range of 20 to 30% a reduction in insurance premium. So it's a huge advantage, again, of working with a large, well-established sponsor. See if there are any other questions here.
I see one, Franklin.
Okay.
I was curious to understand the loan. In initial paperwork, I saw it mentioned the loan is assumed. What does that mean? Sure, it means we're taking it over. So we're taking over the loan, we're taking over the interest rate. Essentially, the borrower is now changing hands from the seller to our operating partners. So the loan terms don't change. We just have the remaining term left over. So again, initially it was a 10-year loan, started in 2019. So there's 5 years left, and that's our duration. Is the loan and rate already secured? Yes, it stays in place at 3.57%. With a low loan to value of 66%, a loan to cost of just under 56%. Okay, you're welcome. Yeah, somebody said thank you for clarifying that.
Okay, so here's a question about the property tax exemption and how long is it in place for? Would the subsequent buyer have to keep the affordable housing in place? This is a great question, and it's one of the first questions that I asked, and not only on this property, but as Mark mentioned, this has been on multiple properties that we've done recently. It's ultimately an agreement with a local or with a nonprofit, and there is a limited partnership that's formed and it's recorded on title. So to answer your question, it is in place in perpetuity. Would the subsequent buyer have to keep the affordable housing in place? It's not necessarily that they would have to, and actually that does provide, and I can go into much more detail offline, but there is a way to opt out for the owner of the property. But most likely, and we're anticipating the buyer, just like us, would want to step into and have the opportunity to step into because it would run with the land. It would be recorded on title, and they would inherit the property at the purchase and continue the partnership with that nonprofit. So it does continue. That value that's created year one or at close can continue beyond the 5 years with the new buyer and in perpetuity.
Yeah, just to
That
summarize,
answers.
the property tax exemption is transferable to the next owner as well.
Yeah.
And there's a question here, expected initial distribution timing. Yep, so first distribution is scheduled after the first full quarter of ownership. So again, we're scheduled to close in a few weeks at the end of June. So the first distribution would be after the close of Q3, so most likely in October, and then quarterly thereafter. Another question I see here, Franklin, how long will it take to rehab all the units, full 5 years or earlier? Yep, so we're projecting 3 years to renovate all the units. We have a summary in our investment summary, which you guys can download and view, that goes into a lot more detail on our website as far as the timing, the plan, how long it's going to take. We're basically projecting that we're going to do 80 units in the first year, 70 units in the second year, and 50 units in the third year. And we've had other folks, on other calls ask us, how do you do that? How can you renovate 80 units and not see occupancy drop? Well, if you look at the fact that it's 7% vacant, right? We have 93% occupancy. 7% of the units are empty, right? That's 14 units. So if we do half of those, all times we're renovating, call it 6, 7 units, we could pretty easily get to 80 units by the end of the first year without seeing a drop in occupancy. So very strategic plan, trying to do the most in the first year and then slow down a bit in year 2 and 3. If done sooner, then the exit would probably be faster than 5 years, assuming market conditions are good, correct? Yeah, there's always a chance that we can sell prior to 5 years. Obviously, the business plan is calling for full renovation in year 3. We do expect to see some organic market rent growth of around 3% as well. And so depending on where the market is, depending on where net operating income is, that'll really dictate if we sell prior to 5 years or not. Let's see, any other questions you're seeing there, Franklin, that I missed?
I think that covers everything for the moment.
Okay, I see one here. Is there a waterfall? What is the split between GPLP? What is the management fee? Okay, yeah, we did just cover that. I won't necessarily go through it all again. I would say just reference the financial summary in the offering memorandum and the investment summary. And let me know if you have any questions. I can walk through it with you. Let's see here. You mentioned average rent increases. Does that also include the low income units? It does. So the low income units, the rent rate is determined based on being 60% of the area median income. So they're affordable by definition, and it's just a formula. Each year, the area median income is published for for all different zip codes in the country, but we'll look at this annually, and rents can increase on the affordable units within the threshold of the area median income. All right, is the deal locked into a sale at the end of the hold? Not sure what you mean by locked into a sale. I'll share this. What happens if it's not a good time to sell in year 5? What do we do? Well, the loan is due in year 5. And so we have 2 options. 1 would be to sell, and 2 would be to refinance. So if we are able to successfully increase the net operating income, which we feel quite confident that we're going to do, then we can essentially go and refinance the property. And our operating partners on 18 different occasions have done that successfully, to the tune of being able to repay the existing loan with the new debt and pay back all investors' principal, and then continue to hold the deal until it makes more sense to sell. So that's, to us, probably one of the best situations to be in as investors, because if we're in an investment and we get all of our money back and we're still owning it, we can continue to get distributions through that ownership without having any risk of loss of initial capital. And you can go take your initial capital and put it back to work in something else, which will allow you to compound those dollars over and over. So we love that strategy. It's hard to say, if we want to remain conservative, we'll never come out and tell you in year 5, we're going to refinance and return all of your money. That's a large assumption. There's a little too much speculation for what we like to say. Is it an option? Absolutely. Our operating partners have done it 18 times. So that's another way of thinking about the 5-year time frame. Again, the goal is to sell, but we'll see once the market, what's the timing of the market is and where we are at that point. Okay, I got a question here. I do not really understand what the property tax reduction is about, where it comes from, who funds it. Any way to summarize without getting into the weeds? Yeah, sure. So a great question. To keep it simple, there are incentives out there from local municipalities, nonprofit organizations, et cetera, to create affordable housing. And if you do that, you can get a property tax exemption. And that's what we're doing here. We've done this on numerous deals with the same sponsor. This is where they specialize in this area of investing. And so by keeping half of the units affordable, we get a 50% property tax exemption. So there's no funding of anything. What happens is our property tax bill gets cut in half. And so that's essentially how it works without getting into any further detail. I hope that helps clarify it. Do you do 1031s with investors to a new property when the property's sold? Great question. We, again, we won't tell you that that's the plan. Is it an option? Sure. We'll see when we get there. As we all know, in the past several years, 1031s have been very difficult to do because a lot of the new deals, the numbers aren't that attractive. And so you want to do a cost benefit analysis to see, does it make sense? Are we just chasing a deal to put money into to save taxes, but the new deal may not be worth it? So we'll take a look at that and see if it's an option at this time. At that time, we won't tell you that for sure we're going to do that. Is this suitable for IRA investors? Yes, we can accept self-directed IRA funds. I personally have a self-directed IRA. Many members of my family use them as well. So happy to share more. If you don't have a self-directed IRA, it's a great vehicle to be able to invest retirement dollars into these types of private placements. Okay. Let's see. Can we get a copy of this recording post-call? Yeah, it's being recorded. We'll send it out to everybody. In the meantime, if you want to get the investment summary, it's got more information, a lot of detail. I would say just log into our website. You can see the offering details. We have an overview of the location. We interviewed one of our operating partners, executive vice presidents, who is a Dallas native. He knows the area very well. We also interviewed our operating partners and dove into the details of the deal. So it would be great for you guys to all watch those recordings if you're looking for more details. Okay, let's see. We talked about distributions, insurance. We got a question here on execution. How do you know that we can renovate all these units? Yeah, okay, great question. So again, this is our 7th investment with our operating partners. They have construction and management teams in-house based in Dallas. And we are actively invested with them on other apartment deals in this area, in Dallas and in Houston. We, at those properties, are renovating units. And so it's very similar to what we're already doing with them. They've been very successful at it. And they have a very nimble approach, right? We don't just take a blanket and say, hey, we're going to do all of this to every single unit. They look at each individual unit, and first what they'll do is they'll test the market. They're going to renovate 5 to 10 units. They're going to see and make sure, are we getting the right return on cost for this renovation? Is the rent that we're going to get from these units within budget? better than budget, slightly below budget. We'll determine that right away before going full steam ahead. Now, what we found at other properties over the past 18 months when they've been renovating with the same operating partner, we're meeting or beating a lot of the projections on the post-renovation rents. Now, on one property, we initially planned to put granite countertops in all of the units, in the kitchen and in the bathrooms. It's expensive. And they did it on, I think, 7 units. And they found that the rent premium wasn't worth the cost, that the tenant base didn't need stone countertops. They were willing to pay a very healthy premium by resurfacing. And so that's what we're planning to do here, not over renovating, right? So then they took that data that they found after renovating around 7 of the units with stone, and they changed the remaining units are now being resurfaced. So it's a work in progress that we have firsthand experience with our operating partners, and thus far they've been doing a great job at it. Any other questions that we can answer for you all today? Okay, I'm not seeing anything. Franklin, anything coming into you?
No, I think we covered a lot today. Appreciate
Perfect.
everybody.
Yeah, thanks again. Well, sorry, one just came in. Will you provide updates to the renovations as you're progressing? Yeah, absolutely. That's something that we look at every month with our operating partners on our asset management calls. We really want to make sure we're following the plan, the business plan. We want to be able to see, $200, $250 rent bumps from the renovation. We want to make sure that we're doing the renovation on time and on budget. So we do track that regularly. Okay, let me go ahead, and I think in lieu of time here, we'll go ahead and pause. Well, thank you all for joining us today. Feel free to reach out with more questions, and we look forward to talking with you soon.
Thank you, everyone.